got to have critical thinking. You've got to be able to challenge your own as well as other people's assumptions. In the first couple of minutes with an investor, to hold their attention, show them what you've achieved.
Good evening, everyone, and welcome to our last session of Entrepreneurship 101 for this year. I'm very glad to see you. I know the weather's nice and there's a hockey game tonight, so we'll do our best to end up on time. Who here has heard Peter Evans speak before? We got the fan club in the front. You guys are old hands. Peter's one of our strongest speakers, and actually we've had him do the pitch for a number of years. And before that, he was doing our marketing lectures. So I actually encourage you guys to go online and check out some of his other videos. He has a really unique way of expressing what's needed for a pitch and marketing, things to learn about marketing. A little bit about Peter's background. Before he was an entrepreneur in residence at Mars and the founder and CEO of Speakerfile, where he is an entrepreneur right now, he worked for 20 years in technology in large organizations and venture-backed companies in the areas of strategy, research, product development, business development. Over the last 12 years, he's been working with startups, over 150 companies. He specializes in investor preparation activities in a variety of markets, ranging from photonics to peptides to consumer apps. Peter, unlike a lot of the Mars advisors, actually jumps around. He's not just ICT. He works in clean tech. He works in life sciences. So he's really seen a range of companies, which makes him perfect for this lecture. His clients have been funded by VC funds such as the Charles River Ventures and Sequoia, and they've won awards at investor events such as TiQuest, CIX, and the U.S. Angel Capital Association. He's also been on both sides of the table as an angel investor himself and also running an angel-backed startup called Speakerfile. Speakerfile is an enterprise content marketing platform that allows organizations to make their experts more visible to events and media. So if you're looking for a speaker for an event or a conference or some sort of big thing, he's got lots of great speakers on his website. Welcome, Peter.
Thanks very much, Carrie. I've been told to kind of stay on stage because I have a tendency to wander off. So I will come out into the audience periodically, though, and I hope I don't frighten you guys. But wanted to get started. We've got a lot of ground to cover this time around. It's going to be a very similar format to what we've done in the past, where we have to get through a fair amount of rudimentary stuff that speaks to some of the core components of a good investor pitch. So I apologize in advance. Some of this stuff is going to be exciting because you're going to get to see real live pitches that have raised real dollars, very successful CEOs doing this, raising money from people like Charles River Ventures. Lisa Crossley with QDT won the Angel Deal of the Year in the US. So this isn't some sort of ABC company fill in the blanks exercise where it just feels so generic that you don't understand the context. You're going to see real deals. Other times I'm going to show you some information that looks kind of boring, but we have to get it done. It's going to at times feel like we're assembling IKEA furniture very methodically. And at other times, we're sculpting something really beautiful when you look at some of the pitches that some of these CEOs have done. So let's get into it. We're going to talk today about other people's money. OPMing it, as we often say, is actually a whole different ballgame when you get into this. And you are now moving beyond friends, family, and what we often call fools. Not true. And those aren't angels, by the way, as I often like to point out. But friends, family, is a whole different dynamic. It's love money. Going to other people's money and taking that step into getting somebody to serve you with a term sheet or come in on those terms that an investor that may not know you as well is a whole different thing. It fundamentally changes everything. What I want to talk tonight about is something called the investor paradox that actually gives you a good level set in terms of what's going on both sides of the table. Entrepreneurs want to get to yes. They want the investors' money. They want to move forward with their business. Money is that major barrier in many cases to growth. But at the same time, it's a numbers game for many investors. The better the investor, the more deals they see. The better investor, the faster they can process this information that's coming in. And it is really, at the end of the day, the shields that go up that investors have erected over time. This whole getting to know is really, it's a defense mechanism. They can't say yes to everything that they see. What we have is this whole notion of what I call Venus and Mars. Pardon the pun, but entrepreneurs are looking for, they want capacity with the investor. Do they have funds to invest? Is it compatible with their investment profile in terms of the type of investment and the geography? Do they have a portfolio, the investor that they're looking at, in terms of deals that they've done in the past? Are there like-minded deals? Can they strategically bring some value to the table with the kind of sector that they invest in? And is there any directly competitive investments? You're hoping, and this is something I often caution investors on, is be careful of fishing expeditions. Investors aren't famous for this, but in some cases they may be doing research on you because they have other deals that they're looking at in the sector, or worse still, a portfolio company that they've made an investment in. And also you want to see a successful track record, ideally, as an entrepreneur in the investor that you pick. On the opposite side of this, though, we've got investors that are looking for a team. I'm going to talk to the power of teams tonight and the importance of team in the investor decision. What's the percentage that the team means in some cases on a scale of 1 to 100 points? How many points would you give the team? Show of hands. Anybody? Want to throw one out? Give me a hand. Anybody want to take 80 at the front? Anybody else have a guess? Is it lower? I've heard 70, I've heard 80, I've heard 100. I rarely hear below 70 points that the team is about. It's a really important thing because in many ways, as we'll talk about, the team can overcome bad markets. They can pivot better. They can pivot faster. How many pivots you have before you run out of cash is how lean startup works today. IP. They're looking for some sort of business model or intellectual property as evidenced by patents filed or patents granted that provide some entry barriers in terms of the market that you're working in. Early customers are often what many investors, no matter how early the stage when you move from friends and family, they want to see early customers. They want to see some proxy of success there. No customers, definitely a warning sign if that's going on too long. And lastly, they're looking for some sort of significant technological advantage, ideally, if they're a technology or science investor. They're looking for some sort of a platform, not just a minute feature that could easily be invented by somebody else. So when we talk about this engagement, this process of moving the investor along through a process of education and communicating to them on 3 different levels is where we're trying to get the job done. We're trying to do it emotionally, we're trying to do it rationally, and we're trying to do it at a financial level too. We have to appeal to their greed as an investor. And often if an investor is not greedy and looking to invest in you for that reason, that can also be a warning sign as well. Investors should be greedy. You should be greedy in terms of the money you want to make because it turns everything in the business. So let's talk about why things can go really wrong before we talk about how to correct them. What's one of the worst things that an investor can say to you after you've finished your wonderful 12-minute presentation? We're going to talk about the 12-minute format today. It's probably one of the worst questions you could ever hear. I'm going to come into the audience for this one. Do I have a volunteer? Let's have one. Come on. What's the worst thing you could hear after you've gone on about your business for 12 minutes? Let me think about it. Yeah, there's even worse, actually. You wouldn't hurt me with that one. Yes, sir. You well-dressed man over there. I'm sorry? Have you put any of your own money in it yourself? Do you have skin in the game? Good question, actually. Sir?
What if they ask, what?
What?
Like they didn't get it.
They're what?
If they didn't get it, their question.
They didn't get it. Good. You know what? I actually think that's probably the worst question that you could be asked after you're done. But I'm sad to say that when I see a bad presentation, this is the one that comes up. I still don't get it. I don't know what you do. Let's see a couple more. Isn't your product a nice to have versus a market need? We've heard about pain and aspirin. We've heard about vitamins and health. What sells better? When we're in pain, aspirin sells better. And when investors look at deals, they don't like vitamins, nice to haves. They're looking for pain. If you can't simulate pain or you can't communicate it through the clients that have bought it, trying to solve a real market need, you've got problems. The third one, is your market big enough? Market opportunity, we're going to learn about that tonight. 4, I still don't understand how you make money. Is this a problem for an investor? Absolutely. 5, are you underestimating your go-to-market costs? We talk about things like the cost per acquisition for a customer. If you don't know those numbers, that's problematic on the longer term. At first, we don't, but we need proxies. Okay, whether that's PPC campaigns on Google with AdWords or LinkedIn, all the way through to going out and doing business development activities in a B2B model where we've got to meet with fairly complex customers. Couldn't your competitors copy you is another one that's important. Often that comes up in terms of entry barriers. We talked about that in the context of patents. And do you have the right players on your team? This team always comes up a lot. Now, I would wish all investors were this honest. Sometimes, I won't even put it down to honesty, but sometimes they just want to be Canadian. And they want to walk away and they don't want to hurt your feelings. They don't want to burn bridges because God knows you're going to be successful at some point and you're going to come back to them. But I sometimes wish that they would come out and say all these things. But what you're going to find is that a lot of investors don't. And one of the things you want to do is neutralize a lot of these questions by applying certain principles of the pitch. And how I'm going to frame what we're going to go through tonight is how to really connect at an emotional, rational, financial level by doing pitches that speak to some of these principles around story, thinking about a storyboard and actually making it a narrative that engages people and doesn't put them to sleep. Disneyfying with images and visuals, graphics, with frameworks that make sense. Not necessarily those really big clip art things that make adds a lot of cheddar to your presentation, cheese factor. We don't want that. At the same time, investors are in the people business, so it's important that you personify the pitch and bring the team out that's behind this, the investors, the channels that you've got in your business plan, bringing it to life. Avoiding too much detail, not getting into buzzwords. All of that stuff is an important part of what we call simplification. Remember that in the pitch, what we're trying to do is drive to the next meeting. We're not trying to get the term sheet at the end of the day. It's important as well that you quantify, that you be conversant with metrics, and always use numbers in the pitch wherever appropriate. Not too many numbers, but at the same time, wherever you've got stats, whether it's from an analyst report or it's customer data, it's always appreciated. And lastly, I want you to think of 3 connecting words between everything you tell an investor and the evidence that you have or the proof as evidence by ... That's what scientists are trained to do. You always want to have evidence to back up a lot of your claims. So we're going to go through the components of the investor pitch deck tonight. And basically what I've done is I've taken a lot of components and I've consolidated this into 4 main areas that I think you've got to do to get the job done. And we're actually going to model these slides across a 12-minute pitch, which is a standard pitch format that we use in our Mars Angel meetings to prepare people. It's not 20 and it's not 5. It's about it's just right. It's like Goldilocks and the 3 bears. This bowl is just right at 12 minutes. The real problem, we are solving one that actually is painful right now to a market that wants to pay us. That market is attractive as such. We also have a unique advantage. That might be the team, it might be our patents, so a whole variety of things that we bring to the party. And lastly, while we brought those 3 things, we've structured an investment for you, Mr. and Mrs. Investor, that is compelling, both in terms of the money that we're looking for and what we're going to do with it. So pacing your investor pitch is about, I'm going to use broad numbers here, very, very rough guidelines. I don't want anybody later going, Evans said I can only spend 3 minutes on the real problem. Spend as much time as you want. I'm giving you what is just a standard rough estimate of time, so please bear that in mind. I also want to make a disclaimer both here and to our TV audience out there that, I'm just one guy who does pitches in a certain way. Everybody will move you around and give you advice on how to do your pitch. At the end of the day, you're the one doing it, you're the one in charge. There is no one way to do a pitch perfectly. And that's what makes communication in general a very, very interesting, mysterious art. It's why ad agencies make so much money, is because it isn't a binary thing. It is a mixture of art and science. So I'm constantly humbled by the entrepreneurs that teach me something every day. So 3 minutes here for the real problem. We want to go to an attractive market, and we want to take about 3 to 4 minutes in that range there. We want to show unique advantage in about 3 minutes. And then we want to show that compelling investment with the deal terms, the structure, the amount of the investment, and where we're going to spend it on use of proceeds at the back end. Okay, so let's talk about the so what. We're going to get into this, problem that matters, as we like to say. Now, that part about the IKEA furniture is where it starts, because I have to go through this, unfortunately, to give you guys a sense of the construction of the pitch, and then I'm going to show you some real stuff. In the introduction, what you've got to do is get out your core value proposition somewhere in a single sentence, a unique benefit. You got to talk about a big idea. People like big ideas. You got to go boldly here. And one of the ways to do that is to actually use a metaphor. And we're getting a lot of that. How many people have gone to AngelList? Angel.co? Anybody use AngelList or been to it? Highly recommend you write that one down. If you want to see thousands of entrepreneurs that are all out there pitching their wares, they're on AngelList right now. It's really a way to crowdsource funding. It's not quite like Kickstarter because they're qualified angels funding companies. And they're syndicating money, 25s, 50s, $100,000 checks, and a lot of them are making millions of dollars using AngelList. Highly recommend that you look at that as an alternative to funding. On AngelList, what you'll find is a lot of companies that use metaphors because they're only used if they are only allowed a few characters similar to Twitter to actually introduce their company. I don't know what the character count is, but you can figure it out when you go to the site. You'll see some very, very cool stuff out there. There's one restaurant or one company that introduces itself as Uber for restaurants. How many people have used Uber or heard about it? A lot of you. So do you get what Uber is? Do you know what a restaurant is? That's how good a metaphor works. Now, what do you think that company does? We're Uber for restaurants. We're Uber for 4 words. Do you guys know what they do? It looks like most people in here know what they do. Essentially, what they're doing is it's like a digital wallet. When you go in, you don't even have to settle up with a waiter. If the restaurant's subscribing, away you go. So, and I haven't even gone in and gone through the AngelList profile on them, but I could really, from just that metaphor, know exactly what they're doing. That's the beauty of good communication. When you figured out that metaphor, or however you figure out that one-line pitch, people just get it, and life gets a lot easier for the follow-on communications. So this Uber for restaurants is one thing. Rent, Frock, Repeat is another customer customer client that I've been working with here at Mars, Lisa DeLorme, who's actually got about 23,000 members out there now. And they're in designer fashion rental, dresses for women that cost about $150 as opposed to buying it for $800. It's an amazing business model. And you could even describe that as Zipcar for designer fashion. But what's interesting is she's thinking more about consignment. So actually designers placing their dresses with her and she doesn't carry the load. It's a consignment option. What would that be? Airbnb for dresses. Very big difference, right, between Zipcar and Airbnb. Where Zipcar holds inventory, but Airbnb utilizes existing inventory that owners already have. So you got to really think about what metaphor works for you. It's X, where X meets Y. And then this whole notion of emotion, I want you in the front end of a presentation to create an emotional, visceral response. Why haven't things been done this way before? Be provocative. Nice to haves are not investable. Then we have to paint a picture of who's got the pain. We want to define the problem, the current state of insanity. We want to talk about historical evolution, if that makes sense. Why has this not been possible until now with cloud computing, for instance? That might be one of the things that unlocks the value proposition or the business model. Who are the main personas in the market that you're addressing? Whose pain are you solving? And then pictures. Weave some pictures into the front end of this to give people a visual. Because again, the text only carries you so far. And then your solution comes into the rescue next. And what you're working on now is a product screenshot, maybe a product photo. You may want to show some functionality. I'm going to show you what I call a who-do. And in fact, I got that tip from Dave Gray from X-Plane, who talks about who's in the scene and what are they doing. Show me a topology or a schematic or a day in the life of your customer as it exists today. And that's the pain. The gain is after they've got your product. I'm going to show you how you can play that off quite nicely in one slide. The category where you play, the readiness of your solution, you may want to speak to where you are and not misrepresent how far you've gone with this if it's only a prototype. And that's important in this setup as well, that if it's not a real product yet, that you at least disclose that and don't mislead people. Because sometimes I've gone right into a presentation all the way through to find out that it's all screenshots that were so well done I thought it was a real product, and it's a bit of a letdown at the end. At the end of this chapter, you want to show what you've achieved to date. Things like when you were founded, the number of employees, the advisors you've got, beta users, how many paying customers do you have, partners, your media coverage, industry awards, any patents. and show people an executive summary of the traction that you've achieved. Now, you're probably confused by this point until you actually see how you actually use it. I'm going to show you 3 really big slides really fast with a quick pitch of how to do this. I want you to listen up, because when I see failure on pitches, it's often on the first 3 slides. I know whether something's going to go well or not after those setups. And this is where most of the time is often spent when I'm coaching companies, because often they know their IP. They often know so many things about their business, but they don't do a good job of engaging people. We're in the tooth decay business. QDT, as understood here, as they do this presentation, QDT Dental actually was targeting the whole notion of tooth decay and the fact that most detection methods, X-ray and visual detection methods, have remained fundamentally unchanged for 40 years. And the dirty little secret in dentistry is that so many of these technologies fail to really give an accurate picture of where the tooth decay is and how badly decayed a person's tooth might be. And in fact, less than 50% of the time, tooth decay is accurately indicated by these methods. You with me so far? Is this a big market potentially? Do we all have teeth? Yes. Do we all go to the dentist? Yes. If half the time those X-rays that we're getting are not working as well, this is a big market. That's why we invented the Canary system. It's a hardware and software solution of interactive software and printed patient reports using a low-powered laser, which is very safe. When it's put on the tooth by a dental hygienist or a dentist, it emits a standardized number that identifies the degree of issues you've got with the teeth. Very, very cool. You show the product and away you go. You with me so far? We've seen the problem. We know it's a fairly big market. And then once you know what the pain is and the gain, we move to what we do. They developed a new platform, uses a low-powered laser to detect tooth decay earlier and more accurately than the conventional technologies, allowing dentists to treat the tooth and remineralize it, which is one of their business models, instead of the standard drill, fill, and bill model. Now, this is where it's important in the first couple of minutes with an investor to hold their attention, show them what you've achieved. In this case, the company, when they did this presentation to angels in the US and won the National Angel Deal of the Year award, they showed that they had product, a first clinical dental model with commercial units manufactured, 50 pre-orders in terms of customers with a strong patent portfolio. First Health Canada approved clinical trials were completed, putting huge strategic partnerships in place with companies like Patterson, working with Shine and Glaxo and such, and then showing the amount of money that they've received already and then the amount that they need to break even at the end of the presentation. So what do you think of this company so far? They going places? Do you think they're solving a big problem? Good solution? It works? They're doing well from what I understand. I haven't checked in, but on their website it looks like things are starting to boom and they're getting picked up, lots of testimonials. They're moving it into dentist's office. It's great to see. I think what's important is that we told a lot of information in just 3 slides. If you think I can do this, you should see the CEO when she does it. Pretty amazing. So we're not done yet. Another one that I wanted to show that they talk about is how they can change the world. Like dentistry is a big thing, but there's a bit of complexity to how this machine gets worked into the actual dental practice. So what I'm showing here is healthy tooth, demineralization, starts to decay. Advanced enamel decay is not in many ways detected at the bottom. And what they're doing is eliminating this whole notion of enamel decay by getting earlier enamel decay here with the Canary system and starting remineralization therapies on the tooth faster because they got to it faster. This is a really important slide when you start to look at this. Many entrepreneurs forget to sort of show this Google Earth model of how they work. They take the investor right down to street view, and then you expect them to understand what's going on. All I see is a series of address numbers at that point. What I need to know is what planet I'm on, what category you're in, where are you playing, who's adjacent to this, how will this work in a dentist's office, take me through a day in the life, and you'll get farther with me as an investor. Let's move to the second chapter, attractive market, an ability to scale the business. What kind of opportunity do we have here? Well, this is where we spend time on market size. Can the market support multiple players? What's the reasonable market that we can serve? Are we going niche in certain segments, or are we going broad? What kind of geography are we after? Are we going global beyond North America? Often we're just going to the States at first, but what are your aspirations there? What sort of proof do you have, and what sort of primary research have you potentially done on your own clients, even if you haven't developed a product? Have you got an end sample of data that you can take me through that shows that there's a real market opportunity in terms of the number of people that are going to buy? Next, can you take me into those early customers and prospects? Can you show me a pipeline? Have you categorized those key segments in terms of why they bought? And what are the personas, the customer characteristics, in terms of, why are they buying this? Are there 2 reasons out of 10? And are some of those other reasons that you've built for, are they coming into view later? At the same time, I'll show you an example of how you would lay up your customers. Often we just throw up the initial people that we're talking to or who we've signed, and we don't categorize them in any meaningful way. You've got to provide some context for the investor on that as well. The other thing I like to see is if you've got any quotes from early customers. Customer quotes, they're often left out, but they're very, very helpful. We had a client today that was pitching, and they had an amazing quote from the Ontario government and another one from a major bank. And earlier we were debating whether or not we should use those. Yes, if you've got a quote that's stating numbers in terms of cost reduction or extra revenue that the client can make, get it out there. I'm also surprised, going back to the last slide, at how few entrepreneurs avail themselves of analyst reports and have not read an analyst report to get some interesting data on the market that they're serving. Very, very important. The other thing there, too, is how many trade shows have you gone to? If I'm investing in a company, I'll often ask that. Have you gone to the leading trade show that actually serves the market that you're selling into? And if the answer is no, and I've never even heard of it, I often send them back to the drawing board in some cases. That's a real red flag for me sometimes. The key message here on making money then at this point in the revenue model is this whole notion of growth and profit. I want to see things like pricing, average deal size. If you're signing up customers and it's a freemium model, how many of those people are actually churning? How many of those people are actually converting to freemium or to premium? The cost to acquire is often a key question that's going to come up here. How much does it cost? If it's B2B, it can be $5,000 to acquire a customer. And if your pricing's $4,500, we got a problem. The channels, have you factored in channels into this? Are they going to get paid out of that $4,500 or whatever you're charging? And lastly, the competitive scenarios. If you start getting some of your market share eaten because certain competitors are coming after you once you get successful, are you sustainable from a revenue point of view there? Your go-to-market strategy also needs to be covered here. So you want to show that you've got the systems in place to close deals. You've got talent. You've got programs. Are you using things like Salesforce.com? Do you have a plan to use it? Do you plan to use systems like HubSpot for inbound marketing? Different types of systems come into play here. And good investors will say, what sort of things are you going to put in that allow me, once I put the money into the deal, to scale intelligently? Do you have a capability to test offers, A/B splits, something you should read up on if you've got a fairly large customer base that you're serving? And as well, do you have the ability, in terms of how you're doing marketing and sales, to change up different methods if something's not working? I hate looking at one option where they say, our whole model is based on pay-per-click advertising on Google. I saw something like this a week ago, and actually there was no plan B. If Google wasn't going to work, or there was a problem with the spread on what they were paying and what they were getting from their end customer, there really didn't appear to be a good out for the investor there or for the team. So a good opportunity example to walk you through an example of, here's a company, Blue Zone, that actually is in the anesthesia business, recycling anesthetic gas in operating rooms. They're looking at the number of hospitals and looking at globally how much is actually spent each year in that sector on anesthetic gas, and it's $1 billion market. But then looking at the number of operating rooms, you've got to think in your own business, what's that unit of measure that's going to be the determinant of market size? And in this case, it was operating rooms. And then looking at how many other dominant players are there, you can throw that in. 3 key things to think about with respect to market opportunity. Is it large? Where is it located geographically, and is it growing? Look at the growth rate. Those are 3 key clues. If you actually don't know in terms of the number of operating rooms, because that's easy to get if you're in B2B, and you're in something that's more small business, like Kirk Simpson over at Wave Accounting. It's another company that's killing it. They've done about $20 million in venture financing now with companies like Charles Rivers and Omers. Just a wonderful homegrown success story. Case study for me. But Kirk, actually, when we worked with them in the very early days, we were looking at the whole market size, and he knew that he was going after a major persona here, which was this free agent nation of close to 30 million people in North America that aren't organized the way they want to be around their accounting. And what he looked at was some powerful trends: the explosion in software as a service, the move from paper to digital, people going more mobile with smartphones, and a lot of people wanting to actually see what other people were spending in certain categories in this area of collaborative consumption. What was important is although Kirk couldn't tell you down to the exact SMB number what he was going to have as an addressable segment, we knew it was large, we knew it was massive, but having a really good understanding of the persona that he was going after and the formative trends that were aligning with the growth have made these guys really, really successful. And if I'm not mistaken, I hope I haven't misquoted this, but I saw recently on their website, they're close to about 130 million bank accounts that have been linked through Wave Accounting so far in the software. And I'm probably even light on the number because I'm sure the website hasn't been refreshed. When you lay up your accounts, it's important not just to do a logo soup, but here's some of my accounts at Speakerfile and how we look at it. We actually look after 8 different sectors. The newest one we're turning up is higher education. But we service legal, financial services, healthcare, consulting, media, publishing, technology, and trade association. So I've got large clients like RIM, Cleveland Clinic, and such. But what's interesting about all these sectors is that they're knowledge-based industries, and that's how I describe it. And we've got reference accounts in most of those sectors now that are global in nature. Very important. I hate seeing logo soup because I don't know how you're categorizing your market. This actually makes you look fairly tidy and fairly professional, and that you've got some market focus. Your go-to-market strategy, going back to Wave Accounting as a good example, you may not have an innate understanding of every little thing you're going to do when you go to market, but the investor needs to see some sort of a plan. Has Kirk executed on his plan? Brilliantly. And the plan that they had originally was to build a very big business using these kind of strategies of PR, vertical communities, advertising, offers, value-added offers, and a focus on customer service from a retention point of view. And I like the fact that there's 2 messages here because a SaaS business is often about retention. It's not just about customer acquisition. You want to avoid those churns. So now we're coming into the home stretch, around the clubhouse turn now, into unique advantage, around 3.4 minutes that you would have for this chapter. Again, guidelines. This is partnerships. What sort of value, do you actually, what will they add in terms of research and development, or will they be market-driving partnerships that will take you out for sales and support? What sort of reputation do they have? Are they really a category fit? Because partnerships are extremely hard to nurture. They like to ride the wave. They don't like to start waves for startups. And I think you'll get a lot of questions related to partnerships if you don't have your stuff worked out in terms of why you're doing it. Are they Barney agreements? We love you, you love us. Let's get a logo on each other's website. It's another thing that a lot of people are going to dive into. And if they don't make sense, they don't have the right incentives, and if they're not aligned even from an M&A perspective where that potential partner might be able to buy you at some point, it may pull up questions. So when we also look at technology and IP leadership, this is the patent zone. Have you looked at filing any provisional patents? How are you different? Do you have process patents? Are you looking to license out? And if you are going to license your technology, then you are playing a patent game for the most part. Your team and advisors. So what you want to focus on is a very simple slide showing where they've worked before. When I can't see names of where somebody's actually worked, real company names, it's suspect. I hate to see something like 12 years of progressive positions in leading Canadian companies. That's where they worked, and I have no clue what that means, and it looks like you're hiding something. It looks like something that's at the top end of a resume. Be very specific with company background. If there's any pedigrees, like notable exits where one of the guys worked for a company, it was acquired by Google, we love to see that. Investors do. Some of your planned hires, some of the key achievements that those people have brought to the party, those are important elements of this. So, for instance, this is a good example of how you can get the job done real fast. Do you want to work with a company that's actually on the Cisco website and has their solution embedded right there? The best way to explain this is we're working with Cisco. Our name is Singraphy, and this is Cisco's website today. We are embedded with the channel, and we're out there selling Canadian and US banks as we speak. Enough said. Gets the point across. Again, here's a good example of a competition slide. I see so many people that do really, really light competition slides, but this is really important stuff. And it lends itself, this kind of a format, to showing. I've obviously cloaked some of the competitors here because this at one time would have been quite sensitive. And pick these variables very intelligently. This is actually quite a few. I would say half of these might work for the average business, but Kirk is being very detailed here for a reason, and he got great funding after this. The team example, let's bring that to life. Here's the kind of format that I've seen work quite well. If you've got a really well-known team, name brands like Aeroplan, BlackBerry Partners Fund, MIT, SAP, this is really impressive. We've got 4 major components going on in this company, Unata, which in fact showed with the Mars Angel Group today. Unata's got hipsters on the team. They've got hackers. And what's the final one? Does anybody know? Hackers, hipsters, and hustlers. Those 3 things. The hustlers that are the visionaries that can sell the deal. The hipsters that are design thinkers, often product managers. They have a design experience in some cases if they're designing for mobile and putting things together. And then that hacker at the code level that maybe is doing an algorithm that's patentable, that sort of thing. All very important components of a team. Dave McClure and at 500 Startups and many others are talking about the composition of these teams. And it actually applies across a lot of different markets. I add a 4th one. I call them 4H teams. Hackers, hipsters, hustlers, helpers. That's really important. And when you look at Unata, when you've got big people like Robin Axon and Duncan Hill from Mantella, and you've got Drew Green, who I worked with at Flow Network way back, who's leading up Shop CA, and people from EMEA and stuff. This is really important as well. Get yourself some good advisors if you don't have them, and make sure that you structure those deals accordingly, and that's certainly a whole different lecture. Very important, because it's not credible to go in if the investor's coming away feeling that you need some parental supervision and some mentorship. That's a real issue. You're just not going to get money. Which brings us to a compelling investment. At this point, the upside for the investors needs to be clear. You're actually presenting them an offer, and this is the way you should think about it. The key numbers, the revenues, the expenses, the EBITDA, your burn rate, your assumptions, your scenarios, all of those things like cost of acquisition and such that we factor in. They're going to ask a lot of different questions around the structure and terms. How much is in today already? What are the use of proceeds? How are you going to spend my money? What's your runway? How much time do you have right now in terms of cash before you run out? And if I put money in with all the other people that you're proposing to, where's that going to take us to? When do we burn out on the next round? Does that bridge to break even? And be prepared to speak to the pipeline. If you're saying you've got other investors committed, this gets to be very dodgy if you're misrepresenting the amount of interest that you're getting. So be truthful on that. You don't have to declare everything, but it's a very important game. And avoid those premature discussions around pre-money valuation and setting prematurely some money valuations with people, because those valuations are very subject to change based on the strategic nature of the investment, how much is being brought in, and how much money you may even need to raise by the time you're done the whole process. So at the end of the day, you want to make sure that both the structure of the deal, the terms, and the amounts are all coming together for the investor. And really at the end of the day, what you're trying to do is come up with a very simple framework. It can be 3 years, it can be 5 years, If you've got a hockey stick that isn't building until year 5, you may want to draw it out a little bit more. But remember, the risk associated with a forecast that goes beyond 3 years in today's economy can actually be quite high. And investors are very savvy to this. Number of licenses you might want to put in, as well as revenue expenses, your gross margin, your EBITDA, and maybe show me how the headcount is building, because often that's a big component of cost. And then the financing and use of funds, that summary at the end is going to be the investment to date. You might want to put your government programs in or grants. If you're a scientist and you're applying for OCE and other things like that, you should give me a statement of that, because that's important for me to know. Especially if they don't need to be paid back and they were hard to win. It's a proxy for quality. Your current raise and your use of funds, I've shown you some examples here of some of the things that entrepreneurs will put up, saying this is where we're going to actually spend proceeds. And then what you want to talk about is some timing related to the financing round and any further financing that you know of that you believe you need to go back to the well on. So let's do a recap. We talked about real problem. We talked about the attractive market. We talked about unique advantage. And we talked about compelling investment as 4 major components. But I want to leave you with just a final summary and give you what I think the major attributes of a good CEO are, and the team at large as well. But I think when you're sitting across the table from me and you're pitching me, I'm looking for about 12 major things. I'm not really running a checklist, but subliminally, this is what's going through my head. I want to know that you're honest. I want straight answers to my questions. I want to make sure that there's some degree of vision there. You're a thought leader. You're unique. You've got some customer insight around this. You've been studying it for a while. It's even better if you're scratching your own itch as an entrepreneur and you've kind of lived through that pain, because the best entrepreneurs, as Rick Siegel likes to say, are those people that are fidgety. They're in line one day going, it doesn't need to be this way. Why isn't this process optimized? We need to build an app for this. You know, grab your pitchfork and torch and march with me in the streets. Give me a little bit of money and we'll fix this together. That's what we want to see as vision and chutzpah. We want to see resourcefulness. We want to make sure that as investors, you can make my dollar go far. I want to see logic. I want to see wise, pragmatic decisions. Drive, that genuine passion for early stage and an ability to execute and excite people. The humility is important. We talk about coachability. If I find an entrepreneur's got a lot of tude, I really tune out. It's very difficult. They may be a client, and that makes it even more difficult. But I'll tell you, there's a big difference between some of the entrepreneurs that I work with. When an entrepreneur is hitting me back every 24 hours with what I asked for, that entrepreneur can maybe get 2 or 3 times more value than somebody that's waiting 7 days. Sometimes I don't even remember what I asked for. It takes so long to get something back from a client. I like to see tight cycles. And remember, when you're working with investors, you better get back to them immediately, more than even family stuff sometimes, because the expectation out there is that you're going to respond as fast as possible with the best information, because everybody else is. 7, you've got to have some degree of leadership. We talk about it in big companies, but in startups, it's even more important that you have the ability to attract a team, to keep them, and to lead them to win. You've got to have critical thinking. You've got to be able to challenge your own as well as other people's assumptions. A lot of people are going to move you around and have all sorts of ideas for you, and you're going to need to very politely thank them for their time and move on and find your own true north at the end of the day. The other thing that I really am conscious about, because I'm pivoting, because in some ways I had false positives in my own business. I had a Fortune 50 client tell me that they wanted me to build something. We kind of built it, got halfway through it, and it didn't seem all that interesting to a lot of other clients. That hurts. And that causes pivots in the business. So watch the false positives. That's part of critical thinking. Commitment is important as well. Somebody raised the point earlier about how much money do you have in. I'm going to be watching as an investor, not just the sweat you're putting in, but the real money, which actually counts for something as well. Patience. We call it tolerance to ambiguity. There is an incredible amount of ambiguity in startups that you have to realize is going to be there. If you came out of a big job at IBM or some big corporate and you thought that everything was going to run somewhat more organized, you're in for a major shock when you're taking out the garbage and doing all your own payroll and everything. I'm living it. And, well, not the garbage part. Since we moved to Mars, it's been fantastic, as well as a lot of other things. Credibility, lastly, is so important. You've got to be well-researched. using data to back up assumptions. And I would say the last one that we're talking a lot about today in startup land, lean startup preaches it every day. You've got to be decisive. Know when to hold them, when to fold them, make the cuts, cut your losses, and pivot at the right time, because you only have so much cash. And even if you haven't raised cash, you have to think about this agility thing in a big way. It's huge. And that's it. Love to take some questions.
Thanks, Peter. We have some time for some questions. If anyone wants to go to the mic so the people on the webcast can hear.
Yeah,
Yes.
My question was about the IP portfolio. You talked about it quite a lot. Now, many startup companies who are pitching to investors will not ever have an IP portfolio. So insert what here? Because you've made it quite a big part of your pitch.
Insert a lot of things there instead of IP. A very clever business model, but even that's not necessarily sustainable if there are copycats out there. First mover advantage is not really enough in today's world. I would say that the reason I mentioned IP is that we do have a lot of scientists in the program. We have a lot of engineers. If you can get some degree of defensibility, that's great. Remember, intellectual property is trade secrets. It's all the way through to provisional and granted patents. And in many cases, I think the lawyers make more money on suing people to protect your patents than they do filing them. They've told me so. That's where the money is. And not being too flip here, but you also have to be prepared to defend your IP. I think there's two schools of thought, and one school is kind of fading. That old traditional, got to see a lot of patents, is moving by the wayside. I think now it's about momentum, it's about speed, it's about fast teams that can get around patents, can get around prior art, and in many ways it's about executing. Execution is so different in today's world. I keep saying today's world, but I've just seen profound changes in how fast you can move a business with the kind of technologies that we've got today in the cloud. And that's influencing even some of the deeper science that we're seeing as well. So back to your question, what if you don't have IP? You got to have speed, you got to have momentum, possibly a great business model. Again, another discussion, and that's a whole different lecture. What's the difference between a feature and a platform? If you've got a platform that doesn't have intellectual property, try to figure out a way that you could, with your first mover advantage, exert some degree of power in the marketplace. Patents are only one source of market power. Speed is the other one, I think, one of many. Hope that helps. It's a fairly long discussion, the answer to that one. Yes, sir.
I actually had another question, but the first question made me wonder, what's the value of a provisional patent? Is that worth patent pending just to get some traction?
I hate to say it, it depends. I mean, it's one of those things, how high is the sky? It really is. And the question was, again, what's the value of a provisional patent? It's $3,000 to $5,000. That's what I'm going to tell you now. I mean, that's what it costs on the street. So, and I think a good lawyer would say that's what it's worth as well. What I've charged you for it, and so you can pay $10,000 for, depending on how complex it is with claims and stuff. But a very, very basic, filing would cost that. But you're back to the value discussion. It depends on, are you going to defend it? How many other people are coming in on it? I'm not dispensing legal advice. I also want to say that disclaimer. I'm not an attorney or lawyer. The value is really how well you've constructed that. And I believe the lawyers, for as good as they are, can only give you some degree of guidance as to what they feel your claims are in an area of intellectual property, unless you do a proper amount of research out there in terms of your freedom to operate. What's that battleground look like? There's no crystal ball that people have got on the IP side.
But when you go to an investor with a provisional patent, are they going to...
So here's the deal. It comes down to the thing I can say with certainty is somebody that takes the time to construct a patent that's been done by a decent law firm, a good intellectual property attorney, and has gone through that process, and that attorney can vouch that they saw something there that was worth patenting. That carries something for me. I don't know what we're going to do with that later, where it's going to go, but it's helpful. It's a proxy, one of hundreds of other proxies that I'm putting into your due diligence file, and you're racking up a score. But that is only one small piece of this.
Okay.
But who are your M&A targets? Is the only potential exit to Google, and is it an algorithm? Then I would say patents factor into the discussion in a really big way. There's a good example of how it really depends what you're doing. It's such a broad question in some ways.
Okay. The question I stood up to ask was about your projections. You talked about projections. And of course, you know, that's black art.
Sure, it is.
Can you speak about how to do decent projections that people are going to...
It's a very involved subject. I mean, some people want 5. A lot of people are fine with 3. I think what you got to make sure is that your projections, they stand the test of time. So when you're presenting to multiple audiences, a good investor will sometimes divide by 3, maybe by 4, and take you down to 25% of revenues, and then say, well, what if we make our cost double what you're projecting? They're going to do stuff like that. Sensitivity testing can kill you. So make sure that you stand the test of time. What if the 4 market segments that you've projected are not going to kick in, and 2 of them kick in at 50 points of what you tell me? What if your acquisition costs are higher than what you tell me? It's not $50 a customer. Let's see what it does at 125. They may even build an independent model to assess you. Very important that you do some of that sensitivity testing yourself before you get moved around by an investor. It just shows a lot of credibility.
Okay, thanks very much.
My pleasure. Thank you. Yes, sir.
Hello, thank you for your presentation. I think it presented steps in a very crystal clear fashion. So
thank you.
My question was about analogies.
Yeah.
I'm a big believer of analogies. I was very lucky this last year. I was able to study analogies very deep. I believe they are, if not the core of cognition, a very important part to communication into what it makes people understand things.
Yeah.
And I believe people are not very aware of them. So I was very glad to see you recommend to exploit the power of analogies.
Yeah.
However, when it comes to using analogies like the ones you presented, like I am the Instagram for this, I am the Uber for something.
Yeah.
I've always had the feeling that as far as it makes your product clear, I think it also undermines it a bit.
It can. It can. That's why you have to choose it very wisely.
It undermines your originality, and I think I have this feeling that it undermines your own grasp of the market, because I feel...
So what's your background? What are you doing now?
I study neuroscience and cognitive science.
Okay.
So
you have a passion for this.
Very beautiful topic in it.
Yeah. Well, let me just say this. I mean, I get what you're saying. I think if you pick the wrong analogy or metaphor, as we will say, it can actually do a lot of damage if people are walking around, you know, and you know, they pick the wrong one. I think the pickup line is the analogy. The dinner conversation is the rest of this that we're talking about. So you can't just go out and just use one line, you know, to pick up investors. There's a lot more conversation that needs to go on. So you can't just take one element of this and isolate it. And we're always, in the communications business, we're trying to get to successive milestones. In the cocktail conversation, we're trying to get a business card. That's success. When we get the business card and we do the pitch, we do more than just the metaphor. In fact, we may have dispensed with that altogether. That's already served its purpose. When we get through that meeting, what we want to do is get to the next meeting and into some due diligence, not get to the term sheet on the next meeting. It's probably a further unpacking of our proof and the forecasting and what sort of IP do we have. So I'm only really talking about the metaphor as one of maybe 150 major things we have to get done for an investor in the process.
Oh, no, I understand.
So to your point, you have to pick wisely. But I'm just saying the importance of that is becoming, it's actually becoming more important because people want to hear that in a conversation. And they're evaluating you very easily in that cocktail conversation. How are you coming across? You're constantly being evaluated. And that's your first test, is how good is your metaphor, if you can produce one. If you can't and you need a longer conversation with people, it just might mean that there's a bit more friction associated with your business, and that's what you're going to sign on for.
Oh, thank you very much.
My pleasure.
Just conscious of the time, we'll take these last 3 questions,
Sure.
and then we'll wrap it up. Thanks.
We have the Boston-Toronto Maple Leafs game tonight, so.
I was wondering, let's say you pitched an idea to an investor or investors, and they turned you down. You went back, you revamped your pitch, made the necessary corrections.
Yeah.
Would you advise for or against pitching the idea to the same investor that turned you down?
I think what you want to do is figure out why they turned you down, and understand if you think you've got an engagement strategy there. they should be forthright with you and say, it's not our sector, it's not our space, it's just not aligned with what we want to do. If they're being pretty honest with you, your chances of succeeding again are fairly low because they're giving a lot of people first chances, so I'll be honest with you. But what you want to do is test for what's wrong and maybe set a conditional with them as part of selling, right? If I can rectify this and I can show you a whole different set of numbers, I can show you more proof. If I bring you some customers, you instructed me to bring a first customer, and I can show you why they bought and what they bought at, things like that, I'll do it. I think the fastest way to bring an investor around is customers. You just can't beat it. Or you hired a rock star. You've got an advisory board. You've got the team. You're proving the market opportunity, and other people are starting to sign on. So those are really engaging proxies. So one of the things I want to give you as advice is don't go off in a huff. Keep a connection with that investor because they may refer you to somebody else who becomes an investor or a client. Investors are good sources of connections across a whole variety of things that companies need. So always keep the door open and keep the lines of communication up. Put them on your house file and check in with them once in a while. Let them know what you're achieving. It's important. And they always make mistakes, every investor. Mike Moritz said Sequoia has a list of all of the great deals he's passed on. And read that if you ever get turned down by an investor, and you'll understand we're in the people business and we all make mistakes. I've turned down some pretty funny stuff over the years as well. And that's a whole beer conversation. Yes, sir. At the back.
Yeah, I'm a very experienced angel investor that I know often says of angels and VCs, we're not in the investing business, we're in the exit business.
Yeah.
And I didn't see any explicit conversation in your pitch about exit.
Yeah.
Is there a reason for that?
I left it out on sorry?
I can answer that.
Yeah, go ahead.
We actually have been talking about, we had a VC panel last week with 2 VCs and 2 entrepreneurs, and then a lecture before terms of investments, and before that bootstrapping. So actually Peter is part of our money module. So we've had some other things just to sort of wrap around that it is hard to get all the information in one lecture, but then I'll let you answer it.
Well, it's a good point. I mean, I didn't want to dwell on that too much, but it will often come up. They're investing in companies to exit. How do you exit? Maybe you don't exit. It just becomes a nice family business, okay? Maybe you do an IPO or you get bought. I mean, there's not many ways that you can have liquidity at the end of the day, but every investor wants that. And it's called a return on investment. It's an IRR. So that internal rate of return that they're looking for as an investor, it's about winners and some marginal plays. They'll get some base hits, but they're also trying to get a 5 or a 10x on their investment. One of the questions you'll often be asked, and you should have a good answer, so I appreciate your question, is who would logically buy you? And you may not have that answer right away, but you better have your comparables down. So the competitors that we put up for Wave Accounting, some of those were logical acquirers. And in fact, he's bigger than some of those competitors now that could have bought him, I think, and is on a different trajectory in some ways, so it's good to see. But that will often come up. I do not generally like it when you create a separate slide to say here's the M&A we're on. It's usually a little aggressive to show that and somewhat presumptuous, and usually backfires with many investors. It's kind of like saying I'm wildly entertaining and successful and accomplished. It's boastful. It's like doing that on a resume. It's stuff that they can generally conclude from all the evidence that they're presented. But unless you've got some really, really good insight into the fact that you've got a wired deal with, a big company, it's very hard to sort of put that down on paper. I've seen it done, and it can be really tacky. The best way to do it, though, is to say, well, 2 of our competitors have recently been bought for these kind of numbers, 8 million in, 80 million exit, yada, 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 by these same people that we just happen to be talking to as partners right now. Hint, hint, wink, wink. And there's a lot of that really good CEOs will do. They'll blend that into the deck, but they won't overtly put the word M&A action or anything like that. But you can imply so much from some of those discussions. Because you go, wait a second, wasn't that company ABC the same one that you've got a partnership deal with? And they just bought one of the guys that was on your competitive slide, and you just nod and you just play it cool. That's what the best companies are doing. But I think many of you are probably far away from that right now in terms of where you are in your business. But a more seasoned CEO or somebody that's in an A round really needs to have a lot of that stuff laid out in a good way. Hope that's helpful.
Hi, Peter.
Hi.
Thanks a lot for your presentation. You mentioned that there are a lot of different, I guess, advice on how to build a pitch deck. Now, you mentioned a lot of do's for your pitch deck. What are some of the don't do's that you just mentioned one with the M&A example, but what are some of the others?
It's a really good question. I'd say, you know, one of the things that I really stress for people is that what's the most valuable slide in the deck, do you think, after what you've seen today? I'll show you real quick. I'll just rewind to it. Can anybody guess what the most valuable slide in the deck is? I'm giving away my trade secrets here. Yeah, I think the business problem and solution is good, but going back to slide number 3, it's really, really powerful when you look at it. I call this, you know, put your iPhone and your BlackBerry and your iPad down and listen up, because I'm going to tell you what we've achieved as a company, and then I'm going to successively unpack all of those chapters of the story as we go through. Okay, right here. That's the problem. That's the pain. This is the solution, the gain. And then we do this. That's the most important slide in the deck. It may not feel that way, but what you should be doing is summarizing all of the things that you've achieved, the milestones that you've achieved early on in the deck in the 2-minute mark. Because what you do is now you successfully unpack your product, your customers, your intellectual property, some of your partnerships, all of that goodness that's baked in, but some of the high points around industry awards, media coverage. You know, we were selected as an OCE, winner. You know, we've got government grants that have been put in. This is where you can put all your candy here. You spill it all in the lobby. And essentially what you want to do is now walk them into the boardroom and through a series of other doors in the presentation and unpack some other things. Do you know why this is so important? It's because people tune out. At various points of your presentation, just like you probably did with me tonight, there were some low points and you kind of thought, oh, geez, I got to walk the dog tonight before the Leafs game. You know, it's very important. You got to keep waking people up. And this is a very important slide if done properly that allows you to summarize what makes you tick as a company. Executive summaries are baked into documents for this reason. You're going to tell them everything about the high points of the company, and now you're going to tell them what you told them throughout the rest of the presentation. Very important. Don't leave that out. And I would say just the setup, you know, back to your question. Most entrepreneurs do a terrible job of defining the business problem. Dave McClure says 80% of his investment at 500 startups is defined by the business problem. He sees technology every day. He works with the smartest guys, you know, from Bangalore right through to Palo Alto. And he's saying, you know, at the end of the day, it's all about their understanding of the business problem and the way that they can articulate it in a really unique way. So I would say the upfront time you spend on that. And that's where I tend to spend an inordinate amount of time with entrepreneurs.
Could you just put the example of that up again? Was it the third one on the tooth decay?
Yeah. Which one did you want to see?
The tooth decay. The problem.
Yeah. Yeah. So, yeah, and I would say in the context of this, many companies really can't find that one image that symbolizes pain. And I would say if you haven't found it, keep searching for it, because it's gorgeous when you find pain. And this actually turned out to be that we found a couple of images that, it ended up kind of looking like the same girl 40 years later. And we found an old dentistry picture, and it's great, and it works every time. I don't change this out. I'm going to probably use this every year just to show you. We did another one for Blue Zone Technology. It's recycling anesthetic gas. And as I was talking to the CEO, it was very obvious at the end of the day. I said, I think I know what your first slide should be. You've got a 95 and 5 problem. And she goes, what do you mean? I said, well, the stats you were using, that if you go above 5% on a patient of anesthetic gas, you kill them. You're supposed to put the patient to sleep, not kill them on the operating table. So if we give them 6, 7, 8%, they're dead. So what the problem is the 95% that goes up the flue stack outside the hospital, that's not recycled in any way. It goes right into the atmosphere. One of the most toxic things that we could possibly put into the atmosphere. So it's actually a clean tech play with a health sciences layer, because they're recycling one of the most expensive drugs in the hospital system, which is anesthetic gas. So what we did was we showed an operating room, 5%, and then we showed gas going up the flue, 2 stock images, 95%, and saying we have a 5 and 95 problem. And everybody went, my God, that's so intuitive. And the presentation wasn't really hitting it properly. And when we took that company down to a Mars-sponsored event in Palo Alto, the CEO, she was really popular. Sequoia was the first meeting she took. They wanted to know a lot more, so it really punched through. Anyways, I want to make, Carrie's going to make sure, she's a hockey fan, that we get out of here and watch the Boston game tonight.
So I just wanted to a couple end notes. One is that if you're part of the LinkedIn group, we're going to post Peter's other videos there. If you do get the newsletter every Monday, you've signed up for the program, there will be a link to the slides and the video and everything. So I know there's a lot of information in this presentation, so you have access to it later. Also, anyone interested in the workshops program or the JOLT accelerator program, there is information outside on your way out. And with that, I would like to thank Peter Evans for finishing off the program.
Thanks very much.